So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we are going to be talking about maintenance margin requirement basics, and specifically talking about how they relate to trading stocks. So we'll cover in a future podcast some maintenance margin requirements and how margin works for options trading. But I wanted to get back to basics so you guys have a building block and a foundation of understanding first how maintenance margin works for traditional stock purchases. So when you actually open up a margin account, and most brokers require now at least $2,000 to open up a margin account, what that does is that allows you then to buy stock on margin. And it's just a fancy way for brokers and investors to basically say buy stock with the help of a loan. Now, you don't have to do this, and I definitely don't suggest necessarily that people do this because it can amplify the gains, but it can also amplify the losses. But when you buy stock on margin, you are basically putting up half of the value of stock in most cases, and then the broker is allowing you to borrow the other half of the value of stock and buy the rest of the shares. So for example, if a stock is trading at $100 and you want to buy 100 shares, you would basically only really be paying for 50 shares. The broker would then allow you to borrow the money to purchase the other 50 shares, which in theory frees up a lot more capital for you to go out and invest elsewhere, right? So you can, instead of buying 100 shares of one stock, you can now buy 50 shares of one and 50 of another. And because you've done it in a margin account, the brokers allow you to do this, right? So each broker has their own different requirements. Some are 50, some are 25, some are 75%, some are 70% minimum requirements for the initial margin that you purchase. What happens then is that after this trade starts going on, and let's say the stock starts to decline in value, because that's always the worst case scenario, what happens is that you start losing your equity first. So the brokers know that their margin is protected. So if they gave you, say, a $5,000 loan to purchase the rest of the shares of stock, that $5,000 does not decline in value as the stock goes down. So it's not like you guys are 50-50 partners on this thing on the way down. This conception I think most people have. When you get into a margin requirement trade, the loan that the broker gives you stays in place. It's very much like real estate. If you buy a piece of real estate and you borrow $100,000 from the bank, well, if the value of the real estate goes down, that $100,000 is still owed to the bank. And the same thing happens in a margin situation with the broker. So as the stock is going down in value, now your equity goes down in value as well. And so what happens is you reach these maintenance margin requirement levels, which many brokers might even set them at typically 30%. So that means that when your equity gets down below 30% of the initial price plus the full margin amount, you get what's called a margin call. And you have to basically put some more equity back into this position so that it's not getting too low. So you're not running out of potential equity and the broker is left with nothing. And so that's where you hear all these, horror stories in some cases about margin requirements and margin calls and people not being able to cover them because maybe they have a lot of margin securities and they've all gone down in value. So that's really what it is. It's just this minimum level that says, look, you're getting short or, slim on the equity that you have left in the position. You need to sell something else or deliver some more cash to be able to cover this position. Now, again, this is mainly focused today based on stock trading and stock investing. We'll do another podcast in the future that talks about how it works a little bit more with options trading. It's the same general concepts with options trading, except we don't actually borrow money in the case of options trading. You just basically set aside money in your account versus borrowing it from the broker. So that's a big distinction. But hopefully it helps out. As always, if you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.